in which we just spoke, discussed a given topic, and it became super popular. We got a lot of cool feedback, so we decided to do it again. And today we're gonna be talking about a topic that is pretty close to our hearts, more than Anthony's heart than mine, but and a topic that I think has become incredibly hot in crypto in the last 6 months or so, and a topic in which we're gonna be announcing a solution in a few days. So we were talking about tokenized equities, specifically about yields for tokenized equities and the integration of DeFi and tokenized equities. So we have a lot to discuss, and a pretty aggressive agenda. So before that, I want to give a little bit of an update about Centaura. Probably the most important thing that happened since the last 3 weeks on the webinar is that we launched Kraken Earn in partnership with Kraken. So we're powering the Kraken Earn product in DeFi, which was a project that we worked on for a good 9 months from conception to execution. We think it's one of the most ambitious projects ever done in DeFi. I don't know, Anthony. Do you wanna explain why is this project important? Why is it different? What makes it ambitious?
Yeah, I mean, I think what Centaur has done for quite a long time is offer risk managed, highly complex strategies for many years for big institutional clients. And when I explained to friends and family how we're able to achieve these type of yields while keeping our clients safe, they multiple friends have asked, "Hey, can you do this for me?" Now that product is available to retail through Kraken. So you basically get all of the risk management and yield optimization that institutions get from us in a retail wrapper. So I think the first time retail can feel much more comfortable deploying and being one click and not have to worry about wallets and understanding protocols and liquidations. It's a big move towards abstraction and abstraction for retail.
Yeah, we're super psyched about it. It's off to a great start, and we think it's the most ambitious Earn program in DeFi ever launched by a centralized exchange. So kudos to Kraken for being this forward thinking. And then the other thing is, I don't think you're gonna give an update without talking about the events on the market in the last few days. We certainly had a really fun weekend with all the market volatility and ensuring that our clients were safe and our risk management systems work as appropriate. But obviously it makes many parties were affected, and it makes for a very difficult climate. So Anthony, you probably have a deeper view on the market than me about what's causing all this.
Uh, yeah, I actually honestly wish I had a better view. I think the importance of retail in not just equity markets and global markets is growing. I think more and more retail users are becoming active across different asset classes. And I think the other piece that's surprising to me is uh, the retail users are much more aggressive and really focus on momentum. So, while the equity markets were kind of sideways, the crypto markets were kind of sideways to down last week, the metals markets, gold, silver, copper, exploded higher. And the type of a move higher that seems like retail driven mania than institutional long-term buying. So there's clearly a lot of institutional buying, but it feels like the retail universe jumped on that. So it feels like money is shifting from asset classes quickly, and if you don't have momentum, you kind of get left behind, right? So it's becoming less and less about longer term narratives. And I think there's been a lot of, for Bitcoin specifically, which is kind of help pushing prices down. I think there's a lot of chatter around quantum computing and potentially destroying value of Bitcoin. I'm not a technologist. I've spoken to many, and to a person, they've all said this is a bit overblown. But we all know that when the momentum starts to go down, especially with how active retail traders are, they're just looking for the next hot momentum trade. So, I put out a pretty bullish report because of market structure in January. That's proving not to be correct, but it's a 6-month projection. And I think that we'll realize we'll recapture 100,000 before the summer. And I also think that we cleaned out a lot of bad positions. I mean, there's still too many altcoins that even have any value at this point, and they're down tremendously bad, but they're still half a trillion of value trapped in altcoins and meme coins and things that have lost the narrative. So, I do think this is going to end. I think we've cleaned out a lot of bad positions, and I think we'll grind higher as the year goes on. I also think that the token price is becoming less important. Sorry to jump. I mean, a lot of what Centauro's business is helping older chains build DeFi networks for their tokens, fintechs looking to enter in yield generation space, stablecoins, from more traditional institutions launching and wanting to get adoption. So I think if you're in the infrastructure part of crypto, business is pretty good. If you're in the speculatory part of crypto, you might want to start your summer vacation early.
If there is a saying in computer science circles as a quantum computing is the future and always will be. Like if it's true that quantum moved the price of Bitcoin, it's probably the only thing that quantum computing has done for markets ever. All right, so let's jump right in. Look, the tokenization story has been around since 2017. I was very early in this market. Like if you go back on my blog, and during those years, I was writing nonstop about this. Got really close with several projects, obviously very involved with Securitized at the time, but I always felt that it never took off. So it was a huge disappointment at the time. People were calling security tokens to be the next big thing after the ICO boom. Then we had a little bit of, more than a little bit of momentum with projects like Bido launching that sort of legitimize the space. But in our world of DeFi, we always struggle with finding a good use case for merging the two, that RWA world and DeFi. And this tokenized equity is not something that we plan, but it's something that we just landed into it. We started looking at some of the new offerings, and we were actually working with Kraken on what today's Kraken earn. And I remember one day we came up with this idea that we could do yields for this and show it to Kraken and say, like, we can actually do this and this way. And they almost fell off the chair. And then we validated with others. So what if we do this? And everybody sort of realized that there is a big opportunity here. So maybe this is a little bit aggressive, but we actually think that combining DeFi with tokenized equities in the form of allowing users to borrow yields against the stocks or generate yield on the stocks is probably the one use case for tokenization. Otherwise, there is really not a good reason for tokenized equities. So, Anthony, do you agree, disagree? Is that too exaggerated? Why is that the case?
No, I mean, listen, I think, and maybe it's a little bit, we're a little jaded because we are a yield shop and that's what we focus on. I don't think tokenizing equities in the short to medium term produces a better client experience from a trading perspective. There's, I think the NASDAQ is optimistically going to move to 24/5 trading and eventually 24/7 trading. So that benefit of moving to the blockchain is kind of somewhat negated, and the amount of liquidity at very tight spreads is to move that on chain would take a significant amount of time and investment. And, unless that trading on chain leads to 0-day settlements, which the banks would want to see, it helps them from a capital perspective. This medium term is going to be a lot of money spent for very little benefit to the people who are investing in building on that side. So I think of tokenization as a barbell strategy. I think of tokenization like BIDL is just moving the crypto space to a place where when you post collateral for margin, you get to earn a yield on it, right? Most hedge funds in the banking space and asset managers post treasuries as collateral for derivatives or other positions, and that underlying collateral earns a yield. So tokenizing BIDL and tokenizing other treasury-backed tokens makes sense if they get able to use as collateral, and the person posting it gets to earn that yield. That's just normalizing crypto to TradFi, right? So that's a good use case. The other side, we believe, is the tokenization of equities for one, to unlock the ability to borrow, and two, to eventually be able to generate DeFi yields because that tokenized equity is collateral. That's
Which
the
you
big thing
cannot
here.
do today, which that's probably a biggest unlock. This is a use case that you can do in crypto, you cannot do in equities today. You don't earn yield with your equities, and if you want to borrow stables cash based on your equities, the rates are not exactly
And they're
friendly.
not widely offered either. And there's a
Correct.
reason for that, right? Because so I went to my broker, and I'm a little bit more than a retail user, and they offered me 11% to borrow against my fully owned equities, which is criminal. But they're not doing it to scalp retail. They're doing it because it's very capital intensive for them, even at 11%, to make loans against a fully owned stock because of how the capital rules have evolved since the global financial crisis. So there's not even even if the rates were competitive, there's not enough scale, because it's very punitive for banks to do this. And this is what DeFi unlocks, right? If you borrow against your tokenized stock from a money market, there's no bank balance sheet that's being restricted. It's just the demand for dollars, without any of these global restrictions. So this this move towards tokenized stocks and borrowing against them is not something the banks are going to be able to compete with, because of the restrictions I mentioned.
One thing that was quite surprising to me when we started working in this problem, and again, we're announcing something next week that I cannot describe, but we're going full in into this. When we started working in this problem, it became so obvious to me that the tokenization providers were not thinking about it, right? That they were tokenizing for the narrative and the open, but what to do with the tokenized thing was not clear. And then even last week or 2 weeks ago, whenever it was, we were in this meeting with one of the biggest tokenization providers in the space, and we were challenged as of why not do this with credit. And recently there were a group of credit products that came into the market. So why doesn't this work with credit or real estate or any of the other crap that, I'm sorry, not crap, but any of the other products that are out there, and it works with equities?
So credit, a couple of different things. So while tokenization of credit lets you own fractionalized, so smaller bites of things that you wouldn't have access to in the retail space, the way the credit tokenization has a plethora of problems. So one, I traded credit previously in an older role, and I was a market maker for that credit. My personal investments in credit are diversified in an ETF across multiple different stacks and multiple different credits. But that's how I believe, as a retail investor, you should invest in credit. You shouldn't have massive exposure to a single credit or a single ETF. But most of the credit products that are being tokenized are singular issuer, singular credit. So yeah, like, so it's great that you can get access to certain things, but in reality, it's not really smart to be singularly exposed, because you can't really create a portfolio yet of credit on chain. And there are things like ACRED, but that's private credit, and those suffer from lack of liquidity. Like I think
Exactly.
ACRED
I
is a
was gonna
great,
go there.
yeah, credit products, and this is what people need to understand. So like equities trade on exchanges. equities are the only market on earth that trades super liquid, where retail and institutions trade with each other away from crypto. Most other markets, specifically credit, are intermediated by banks who market make and provide balance sheet to settle transactions that they can't immediately distribute. So credit inherently is much less liquid than equities are. And then trying to bring that on chain through typical AMM models also hurts credit. The other problem is, think who's tokenizing this credit. It's Apollo, it's BlackRock. Tokenizing is great, but you need to get it implemented into DeFi, and that means posting capital and providing liquidity in the secondary markets, which you don't get paid for. So most of the in the traditional world, BlackRock creates an ETF and then they sell it and they make fees, and there's no need to provide liquidity. They just mint or redeem them. In DeFi, if you want to use the not only access to these products but use them as collateral, none of these issuers to date have been willing to put up their own capital to provide liquidity. And that's why you're not seeing them being adopted as collateral in DeFi and not reaching their potential. So that doesn't mean they can't do it. But to this point, and this is what we've been advising some of the major traditional finance firms who are tokenizing their assets, is like, it's like creating a new product and not having a go-to-market strategy, right? So that's where they're caught up.
So one of the debate, I wrote an article about this in tokenization recently. So we have seen an explosion of perps DEX recently, Hyperliquid being at the top of that list, but there are a couple of others that are highly competitive, and many of them are starting to do tokenized equities perps, which you can launch in a day, no issue. And then for tokenizing something, you have all this red tape that you have to do. Like, what is the use case for one versus the other?
The use case of the perps.
Tokenized equities perps, perpetuals versus just tokenized equities.
I mean,
I think perp, not tokenized equities perp.
I mean, you can get leverage from equities from your broker, but I think Ondo yesterday at their conference announced that they're offering 20x leverage perps. So, I mean, at this point, the tokenized equities aren't the same type of ownership structure that you get by owning a physical share, right? They're all in some form a derivative at this point. So a tokenized equity perpetual is, I don't want to say pure gambling, but essentially you would only use that vehicle if you wanted to take big levered bets on these equities, right? This isn't a vehicle for wealth accumulation or diversified portfolio.
That is it a better
pure
vehicle for trading? No, like if the use case is trading, it's perhaps a better.
If the use case, because even within perps is implied leverage, so it allows you to take bigger bets with the least amount of capital, but it's not investing. It's clearly for speculation.
No, whether tokenization is the one that could be conducive to wealth management solutions, like what we're gonna discuss.
Yeah.
Cool. So let's talk about the what or the how. No, the how. So you decide to integrate tokenized equities with DeFi. The two use cases that we're seeing is you can borrow stables, you can earn yield. Let's describe each trade. How does that work underneath?
Yeah. So it comes in two stages. So let me give you just a little background on the market. So there's about 62-ish trillion of U.S. equities in market cap. Roughly 40% is owned by retail. What's even more interesting is roughly 40% of over 30% of the Mag 7 is owned by retail, and almost 40% of NVIDIA is owned by retail. So the kind of the most I don't want to call them meme-ified stocks, but the higher momentum, higher volatility stocks are very heavily held in retail. And if you'd owned NVIDIA for the last 3 or 4 years, you're up 1,000%. Also, the demographics of the retail we're talking about are not, my father who still wants to call someone on the phone to place a trade. It's the more financially savvy, technology savvy, want to do it themselves
It's
type
a
of
the
generations.
Robin Hood user.
Yeah. So, if you invested 10 grand in Nvidia and now it's worth 100, I think going to that same user and saying, "Hey, with one click, we'll let you borrow 20 or 30 grand at 6%," um, is going to be one of the biggest innovations of DeFi and tokenization the market's seen. I mean, think about it. You have 25 trillion. If even pick a percentage, 1%, you're already bigger than DeFi right now. So the scale of this is so much bigger. And the benefits to DeFi are you bring in this relatively price insensitive borrower because you're offering them a completely new product that they've never been able to access before. So they're not going to, their need to borrow at 3 or 4% is not a requirement. And I think we can get 5 or 6%. This large scale demand between 5 and 6% will elevate all DeFi rates in the market. It'll just take the floor down up from 4% where it currently sits now, or 3.5% where it sits now, up a few hundred basis points. Up a few hundred basis points from here, so many other financial products start to make sense in DeFi. So the reason, one, I think the biggest innovation in all of this is giving people access to dollars of their appreciated shares. That has a secondary effect by raising all interest rates in the DeFi market, creating other opportunities. And then moving on to what is a kind of a superpower of Centaura through this proprietary algorithmic trading strategy or yield generation strategy, uh, is we can use so let's say you have this tokenized NVIDIA and you don't really want the cash, but you would really love a yield. And typically Mag 7 stocks don't pay dividends. So if using our proprietary technology and assuming the environment is stable, you should be able to generate 3 to 5% on these kind of bigger, liquid, higher market cap tokenized equities. And so I think being able to borrow money at scale for retail users is transformational to the market. It's also transformational for our economy. If $1 trillion is borrowed, which is 1/60th of the overall market over a course of time, and that money is borrowed to be spent, whether it's on housing, whether it's on cars, whether it's on purchasing more equities, just that unlock could create a huge economic boom for the U.S. in particular. But then the next innovation is being able to take a zero dividend stock with a high volatility and then slap a dividend on it. Right.
So
That's
how would it work?
transformational product.
Because then we're
So
gonna start breaking down the details of the trade. And
yeah. So this is a similar strategy we use for Bitcoin and ETH. Bitcoin doesn't have a natural yield. So the way we generate natural yields on Bitcoin is we supply the Bitcoin into a money market, borrow one of the cheaper stable coins, swap, and enter into a series of other stablecoin trades that generate a higher yield and create a net yield on Bitcoin. What's the secret sauce is that the algorithm the smart contract which manages this trade constantly levers and delevers the trade to avoid liquidations. Right. So if the Bitcoin price starts to drop below a certain threshold, the smart contract unwinds the stablecoin leg and gets the health factor back up. And if Bitcoin rallies, it takes on more leverage to maintain the same health factor. This is extremely important for equities because if you're up 1,000% and we put you in a yield trade that makes 3 or 4%, and somehow we don't protect you against liquidations and you get liquidated, you now not only not only did you get liquidated, you now own capital gains tax. So that's why doing this this strategy is complex, but is also necessary because earning 3 or 4% to then pay 20% in capital gains is not a great outcome.
this trade is incredibly complex. People it conceptually simple. You supply thing, borrow another, deploy that other. But the managing the liquidation risk on a block by block basis is incredibly difficult to do. That's why nobody else does it in the market. We've seen it when the yen carry trade blew up and Bitcoin dropped 20%. We saw it resilient on October 10th. This weekend was fun. Like we had quite a bit of exposure to that trade, and we're able to and the algos were fine, but you always get nervous that something might blow up. So enabling this for equities is quite interesting. Now, on that liquidation part, liquidations for equities and liquidations on DeFi and on just native crypto assets are a little bit different. So how does liquidations work for something like this?
So liquidations for tokenized equities is an evolving space, and is something that needs to be. It's not a copy paste of how we liquidate Bitcoin, because tokenizing, the way we liquidate Bitcoin is we liquidate Bitcoin into deep AMM index pools, and if necessary, centralized exchanges. There's plenty of accessible liquidity within one hop of these DeFi protocols. Equities, there's too many people approaching this tokenized equity leverage trade or access to cash in what I believe is the wrong way, by trying to build secondary liquidity pools via DEXs. You already have trillions of dollars of day trading on the NASDAQ and the New York Stock Exchange. To replicate, for this idea to scale, you need to use that liquidity, because trying to build that secondary liquidity on chain will inhibit the growth of this product unnecessarily. Now, so this is a hybrid type of product, and the liquidation works as such. So when a liquidation happens, the liquidator needs to send the dollars or the stable coin to the protocol to win that liquidation. Then they need to send an equal amount of dollars to what's called a securities lender, borrow the individual stock, and sell it, all at the same time, in parallel, unwrapping the tokenized stock. So they send money, win the liquidation, send money, borrow the stock, sell the stock on the NASDAQ. Then wait 1 day, 2 day, 3 days, whatever tokenized stock issuer's format is, receive the tokenized stock, return it to the lender, receive their cash back, and everything collapses, right? So that can be 1 day, that could be 3 or 4 days. Now, we've seen some innovation with some of the issuers like Ondo that can wrap and unwrap within hours, which actually really reduces the risk factor. But we need to see market makers who have a decent amount of balance sheet enter into the space, because it's still a balance sheet intensive trade. More so than, like, you can't do a flash loan liquidation on equities, because the liquidity sits in a completely different market. But having market makers step in who trade both the crypto markets and the equity markets, is we started to see those guys. And then now the next leg of this iteration, like what I presented about yields and borrowing, is the end state. We're here. So the idea is, like, this next move where you're getting liquidators that can liquidate in both markets is bringing us to the next step forward, but not the end state.
But by I think this being a nascent space is probably a nice way to put it. We really haven't seen anything super bulletproof on this yet. Like, it's an area that we're trying to figure it out. Like, I think it's safe to say that there's some tokenization providers that don't even have a good solution for this right now.
No, I mean, some, again, the other thing you bring up about tokenization providers. So currently, the trade that currently you can buy tokenized shares and then post them as collateral. I think that's a decent first step, but it's never going to unlock the trillions we're talking about. What we need to be able to do is take shares that you already own, exactly, transfer them from Morgan Stanley or Schwab to, say, a Kraken or Robinhood, and then tokenize them as a tax-free event, right? Like, converting it from your shares that you own for 5 years to a token shouldn't create a capital gains tax, right? So converting those shares that you've already appreciated, and then having access to borrow and yield. Nobody has that solution yet. And
yeah,
the reason,
and when we start mentioning, people look at us that we have 4 heads, right? Because that requires integration with your broker dealers with a broker dealer network to be able to do that. To go from my Microsoft stock to my tokenized Microsoft stock behind the scene to yield on my Microsoft stock.
Yeah, I mean, the biggest, there isn't a technology innovation or a regulatory innovation that you're going to snap your fingers and then there's going to be 10,000 tokenized stocks the way we want them. Unfortunately, the old school traditional Wall Street rails are going to be hard to disrupt, because it's not the clearinghouse. It's not the tokenization agent. It's not the broker dealers who decide if you can take a share owned in DTCC in your name and convert it to a token. It's each individual issuer of stock. So for this to open at scale, you have to go to Tesla and ask Tesla, and Tesla has to agree that a certain portion of their outstanding stock can be tokenized on a ledger. Then you go to Microsoft and Google. There is no big bang structure currently that will allow for, so the Ondos and the Backs of the world and however many others who are trying to get into this tokenization game, securitize, they have to not only have the technology, but they have to convince every single issuer that they want to tokenize to allow them to tokenize it. And I think that's the biggest friction point that I haven't seen any realistic plan on how to tackle at this point.
But without the use case, it's harder. But if you have something that you can earn yield on that stock, that makes a compelling use case.
I mean,
without that.
Well, the question is, so I think it's compelling as a, if I could own a tokenized stock and borrow, but like the people selling to Tesla need to explain why tokenizing stock's good for Tesla, right? Or good for Nvidia. And the problem is I'm not in those conversations, right? I'm sure they're trying, but it's actually extremely compelling for a stock issuer to have this tokenization for these two reasons. One, if Tesla allows people to tokenize the stock, two things happen. One, if that stock is used as collateral, that's less Tesla in the market that can be sold. So you're shrinking the amount of available securities available to be sold in the market. Well, that should be at the margin, price increasing. The second is you take a stock that does nothing for you but go up or down, and then you add the ability to borrow against it, makes that whole proposition attractive. So if Tesla's the only tokenized stock that you can borrow against, that's also going to be price accretive to these issuers. So it's actually a compelling argument on both sides of the equation, right? For the issuer and for the borrower. Now, the third component is if you could take Tesla that doesn't pay a dividend, and by using it in DeFi can earn a dividend or earn a yield on it, that completely changes the asset allocation game, right? Because typically when you allocate to high volatility stocks, you don't earn a dividend. When you allocate to low volatility stocks, they have a dividend. So getting a high volatility stock and a dividend is going to at scale will completely change asset allocation.
So in addition to the liquidation risk, or expanding the liquidation risk, there is the trading hours mismatch, and which tied to the Oracle problem of this solution and all that. Like, so crypto is 24/7, equities are not. How does this type of solution works in after-hour markets or during the weekends and those type of?
Well, that's a problem that's going to fix itself because all the major exchanges have announced plans within the next 6 to 18 months to go 24/7. So that piece should be either minimized or eliminated. There is after-hours futures markets that can trade. But until we have after hours liquidity or gap liquidity, we just have to set the LTVs more conservatively, which is absolutely fine at the early stages. But as that liquidity becomes more seamless between on and off chain and tokenized versus physical form, that problem will go away. So hopefully we've been able to lay out where we're going. We're not there yet. We know what the challenges are, and we're incrementally making progress along the way. But this is going to be the end state, and this is going to be an extremely attractive new set of primitives that validate the use of DeFi and crypto rails, in my opinion.
And then how do you, how about the Oracle problem, which is another thing that we wrestle with quite a bit? What is the right price? Right? Where do you get that from? What do the Oracle providers need to do?
I mean, Reuters is a TradFi version of an Oracle, right? They have price feeds. Bloomberg has price feeds. I mean, that one, I'm not a tech, I'm not a engineer, but it feels like if someone who was trying to solve this problem correctly and was open-minded, they'd work with both on and off chain type of Oracle providers. And there's definitely a solution in between, because Oracle providers like Bloomberg and Reuters send prices in milliseconds. So that answer already exists. So is it Reuters?
Yeah, so now you have trading on both sides of the Oracle. You have trading on the on the equities market and now trading on
Yeah.
chain or things like that that could get
You know,
quite.
but that's also a good point. So there's going to be a difference. There's going to be a spread. And this is my kind of challenge too. I'm not like super bullish on tokenized equity trading on chain in the early stages because one, you're going to have to pay for the tokenization, right? So if I want to buy NVIDIA, I buy NVIDIA at Schwab and I pay nothing. And I get the mid-market price or whatever the auto spread gets sent to me. If I do it on chain, I'm paying some amount of tokenization fee. And I'm paying for the fact that the slippage in the bid offer is going to be much wider on chain initially, and that's going to be a fact, right? And this is going to, and what will end up happening is more and more trades on chain, which again, I don't know why you'd want to own it on chain if you couldn't do something else with it. So I think this something else with it that we're pushing needs to come a lot faster than just tokenizing it. I just think they'll fall down if all you're doing is trading them there at a much higher cost. I mean, the cost could be, materially higher to buy a Tesla or Nvidia or Google on chain than in your Schwab account. And if you can't do anything with it, why are you paying that extra cost? So, assuming we get over that, there'll be arbitrageurs that'll bring that market. It'll start wide, and then the arbitrageurs will come in and take those spreads. But that's a multi-year, if not, I don't want to see decade because everything's moving so fast these days. But that's going to take a significant amount of time and a significant willingness for people to buy stuff at a worse price, which again gives me a little pause on just tokenized treasury trading in general.
But by the way, if you guys have questions, you can use the Q&A panel or the chat. Our marketing team posted a research paper that our research desk wrote about this topic that is quite compelling. So where is this going to happen in DeFi? Like I know where we're starting. Is this going to happen in Aave? Is this going to happen in Morpho, Euler? Like what are the first building blocks of DeFi that are well suited for this? And B, related to that, you need a lot of stables to make this work. So what are the venues that can enable that?
Obviously, Aave has the largest amount of available liquidity. Other like Morpho are growing their available liquidity, but I look at this tokenized stock piece in an ecosystem. So on one side, tokenized stocks, if I'm correct, get used as collateral and create a huge amount of borrowing demand. Now, if there's 150 billion, so a very small amount of the equity market that gets access to borrow, there isn't 150 billion of stablecoins to meet that very small demand compared to the overall size of the equity market. So how do we meet that demand? Let's put this piece aside. The other thing that Centaur is really focused on, and this is what Kraken Earn is kind of one of these portals, is creating a product where users can use stable coins instead of bank deposits and DeFi instead of treasuries to manage their money and control their money. And what Centaur is really focused on is building safe yield products with insurance to pay users by deploying their stablecoins in a Centaura front end or Centaura partnered product and earn twice the treasury rates and earn 1,000 times what you're going to get in a checking account. And I think these products are being rolled out by Revolut, by Kraken, by Robinhood, by Crypto.com, WireX, PayPal.
You mentioned insurance, and there is already a question about insurance in the show.
I'll get to the insurance in a second, but my point is I see these two mega trends merging, right? So a bunch of dollars coming on chain as these neobanks and fintechs are all moving, and that's one of the biggest metas in the space, are all moving to offer DeFi type yields with complete abstraction and offering neobank products that are going to compete against traditional deposit institutions. That side of the trade brings in a ton of stablecoins. The tokenized equity brings in a ton of demand to borrow stablecoins. Now, if one of these happen faster than the other, you could see a market distortion in one way or the other. So if the demand for tokenized equities comes in much before the neobank tokenized deposits, you're going to see massively higher rates and it won't scale. If we get too much of the neobank deposits, all the yields are going to get depressed. So I see the future state where you're going to have two relatively price insensitive borrowers and lenders meeting on DeFi rails, and I think the timing of which is, you know, I would hope that they would meet at the same time, and this scales into the trillions. As far as insurance, I don't know if we're going to make this a shill session, but we've launched a protocol called Firelight that ensures both economic risk and smart contract risk by converting that smart contract risk and economic risk into collateralization risk. So, from a high level, if you want to purchase insurance on a position or on a vault, you're actually purchasing amount of collateral sitting against that vault in case it gets exploited. If it gets exploited, you seize that collateral and sell it, and that's what the Firelight protocol does. That's the TLDR version. If you guys have more questions about that, you can go to firelight.finance. We'll put it in here. But we are building Firelight not to ensure individual trading strategies, similar to what like a Nexus Mutual has done and some of these newer insurers. We're also not tokenizing a reinsurance product. We're focusing on purely DeFi insurance. That's both scalable and economically and commercially viable for both the stakers of the collateral that are going to insure the protocols and the buyers of the protocols that are going to pay for it.
So, so if we manage to not screw it up in the next few months, we might be able to offer yields on your NVIDIA stock full insure.
Correct.
Which is sort of the North Star.
Or on your deposits, right? On your tokenized deposits. I mean, listen, what does everybody use their bank account for? You don't use it to buy treasuries. You don't use it to buy stocks. You get your paycheck and you pay your bills, right? That's really the only thing I use my bank for. So if I could get paid in PayPal and use PYUSD to pay my Amex bill, or use PYUSD to move money to friends, or use Venmo apps or any other of these neobanks, I think traditional brick and mortar institutions, when the older generations die off, are going to be completely useless for this generation. And I think that's the big meta that many of these neobanks and fintechs are investing in. And I think it's the big thing why the Genius Bill is stalling, because the banks are extremely scared of this narrative taking flight. And they're doing everything they can do to kill, because at the base of this narrative is stablecoins. And this is the battleground. And this is why these banks are coming up and putting up in all these amendments and really butchering this Genius Act bill, because they know if this world actually happens, it's going to be materially destructive to the banking industry as we know it.
So I had a question there at the end, but I'm going to drop a nugget, even though we're talking about this. In a future state, like fast forward a couple of years, who wins this race in our mind? Like, is it a platform like Robinhood that has all the equities, Rails, and needs to enable the crypto and DeFi side, better equipped than a Coinbase that has a crypto, not DeFi yet, but is enabling equity, better equipped than a Kraken that is already taking steps, obviously launched DeFi Kraken Earn with us and bought X stock, so they're going like who is best, or is a neobank with something like who is best positioned to?
So I think my background is in trading, so I lay out the landscape of things that are going to be products that people are going to use, that are going to make the producers of those products money. That's how I think. That's not how the crypto industry thinks in general, but especially from a product perspective. To me, Centauri can and will build all of these products. If we wanted to do this ourselves, our biggest challenge is adoption, right? The user base. So I think the firms that are going to win in this race already have a significant amount of users and are able to see this vision and execute on it quickly. I know it's somewhat relevant because of the recent move in the stock price and the announcement about PayPal. But PayPal is positioned to really win with, they have, understanding the stock's down horribly. They just changed the CEO. They have 400 million users, right? Almost 500 million users. Coinbase has, I don't know, tens or hundreds of millions. Kraken has tens or hundreds of millions. Like, I think it's bringing an MVP to market as quick as possible and deploying it into existing user bases. Because
It
I think trying
feels
to
that
build this
way.
on our own and try to build it from scratch, because the consumers already consume financial applications, and I think it's going to be hard to offer this in a nascent new business that nobody knows, even though the functionality is awesome. I mean, it, I don't think it's a growth strategy. I think it's a defensive strategy. I think if you don't offer these products fast, you're going to lose traction with your existing client bases as opposed to bringing on new ones. And I think it's going to become a battle between the existing incumbents who have these users who consume financial products.
So I knew you were gonna use the NVIDIA stuff at the beginning. So I was brainstorming with Gemini and ChatGPT a couple of spicy questions and dropped this one that cracked me up. That was, so who is the user of this trade, the NVIDIA holder or the Johnson? They said the Johnson and Johnson holder.
Um, so when I spoke and gave some statistics, I was looking at the behavior and the generation of the user, right? And this is why I focused on NVIDIA, because of the high retail, high younger generation participation. I just don't see. I mean, my parents still write checks and call the bank when they have questions, right? Like I just don't, and they probably own more Johnson and Johnson than the millennial or
But would they
whatever the
use
25-year-old
some,
college.
if they can borrow cash with something like this, would they do it? Or this is,
Yeah. Well, when they get it in their inheritance, maybe.
yeah, okay.
Yeah, I mean, listen,
It's
it's always smart to defer taxes, right? And maybe that's too blanket a statement, but if you have a position that's in the money and you don't want to sell it anytime soon, and your ability to borrow, I mean, these tokenized stock loans will be cheaper than HELOCs, home equity lines of credit, by a material margin. And you won't have to file paperwork, and you won't have to apply, and you won't have to wait. You're going to click a button on a Kraken app, and it's going to be done, right? So I think the flexibility, and listen, Coinbase did a really good job with Bitcoin loans. They made it super easy for people. You have Bitcoin, you want to borrow money, click one button, and behind the scenes, the Bitcoin is going to Morpho on Base, and they're borrowing USDC on Morpho and then delivering it. But for the user, it's completely abstracted, right? I have Bitcoin. I want to borrow 50% against it. In 10 seconds, I have stablecoins in my bank account, in my crypto account. Like, that's super powerful. And delivering that to the most amount of users is going to be either an edge or uh, a competitive advantage you're going to have over the incumbents.
so are there, I think there is a question there by my friend Archie, but I think we alluded to this somehow. Are there any regulatory hurdles here? Like it seems like all these tokenization providers in some way or another are engaging with regulators to see what is possible. And
I mean, I would say there's probably there's two ways to go about it. If we go, the guiding principle of equities is that each share is held in the name of the person who holds it, who owns that share. And whether that's held at the DTCC or held at your broker, they're all held in your name. So if you want to follow within that rule set, and I think that's what Securitized wants to do, that's what Open Bell from Superstate wants to do. If you're gonna build within that, there's really no regulatory hurdle. Where you're seeing regulatory hurdles is when you're trying to create these wrapper derivatives, right? Where you don't actually get the voting rights, or you don't have a claim to the dividend, or you're getting a representation of the stock in a token form that's not actually the stock. So I think that's where you're going to see the clarity. I think if you just try to tokenize
but
and you
that's
get
a
the
lot
issuers to
easier.
agree,
It's a lot easier to do, to be fair, to do the derivative and to do the full.
it's easier to do the derivative to get it up in trading, but it's not easier to get fully owned shares converted into that vehicle,
Yeah.
right? So I actually don't think there is a regulatory hurdle. I think there's a go-to-market hurdle and there's a realization hurdle, but the path is pretty clear. And Securitize and others have made it clear that's what they want to do. They just need to sell each company.
Yeah. So let's close with one thing and then we can do questions, although I don't see a lot of questions here. So if you have questions, use the chat. So what is the future of this? So I'll outline a use case, a story like of Microsoft Nvidia holder in 2028 in Robinhood or Kraken or Coinbase. What can they do?
I think at scale in 2028, you're gonna for retail users that hold multiple stocks. Um, I don't think you're ever just going to hold them in an account again. You're going to either delegate them to be earning yield, or you're going to borrow against them. And if you don't need cash, then you're basically going to own all your stocks, and then you're good. You know how when you buy a dividend yielding stock, you can click a button to reinvest or take the cash. I think there's going to be a third button is to earn yield, and that's just going to become programmatized, if that's even a word, within the selections in these wealth management apps, whether they're the incumbents or new ones.
Yeah. So there is a question here by Federico, who's been really active on this. That said, like, if I think this is about the derivative thing. If one could feature stuff from a stock, meaning the voting rights and all that, does it change the price?
Um,
Like, is a thing without voting rights or a thing with voting rights the same?
I think it's more of a regulatory problem than it is for the user. I mean, I don't really vote my proxy votes. I don't know how many people actually do that from the retail side, but I think it's just more of there's a bigger risk that those type of models get shut down from a regulatory perspective, or they're just done all offshore, which doesn't help because the U.S. equity market is the biggest market in the world. So, like, going after the UK or the European market's fine, but it's you're not going after the elephant; you're going after the squirrel. On the
So
tokenized treasury bills,
yes. Oh my God.
um, yeah, I mean,
Can you
tokenizing
answer
treasury.
like can you answer it in this market in this market?
Yeah, I mean, tokenized treasuries are great when the Fed funds rate 6%, but the ADP number and the inflation numbers are coming lower. They're going to cut rates, and at what level do you really want to allocate capital at 2 or 3%? So tokenized or untokenized. So to me, I, unless I was posting it for collateral, I don't think anyone like myself would ever want to own, because I could just buy a money market fund and get charged less fees than owning Biddle or owning a Ondo token or USDY or whatever. So for retail users, I don't see it very useful unless I can use it for collateral if I'm trading derivatives.
Yeah, there is a related question there. Like, it should be super easy to rebalance between TBOs and low risk DeFi yield. We looked at this, right? Whether to anchor something like
Yeah.
Beetle as a basic yield. It should be doable somehow. It hasn't been done, right? But there is no. I think Beetle established a base yield for the entire space. So
I want
yeah.
to answer my friend Ben's question. He says, "Who's within DeFi is best positioned to benefit from tokenized equities?"
I mean, I'm assuming he means
Well,
protocols, no? Because if not, the answer is us. Yeah, exactly.
yeah, I think us for providing the strategies, Morpho, Aave, for sure. And I also think the stablecoin issuers, the circles and the tethers, because they're going to be the currency for this. So I think this trade at scale will expand the money supply and will further move the migration from bank deposits to stablecoins, and allow Scott Bessent, the Treasury Secretary, to fulfill his projection of 2 trillion in stablecoins by 2030. So the stablecoins are just the grease in the engine here. So I think they benefit massively from this.
Cool. I think we answer everything. So we are. Oh,
Oh, do you want to? Oh,
Brian.
sorry. So Aave will absolutely.
Oh my God, the
They,
spicy question. Uh,
I think Aave Horizon for the permission versions of
exactly.
tokenized stocks, and then I think Aave V4 when it launches will accommodate the kind of non-permissioned versions, but I think it's still TBD. But you have to.
So
They'd have to accommodate the biggest trend coming.
so next week, we're gonna announce a big release on this. I cannot even tell you the name because our legal counsel hasn't approved it yet. But it's gonna be splashy. We're gonna announce a bunch of partnerships and a first solution. So stay tuned. Like, this is not was not a theoretical webinar. We actually have been working on this for the last few months. Then we're gonna be announcing the new webinar in the I don't think we have it today, so in the next few days, you'll get the email. Yeah, I don't think there are any more questions, so I hope the discussion was fun. Thank you for joining. I will see you on the next one.
Thanks, everyone.